Hello and welcome to Something More Mentoring, module number 5. We have our insurance topic this month. And let's take a look at where we've come and where we are to put things in perspective. So if you recall, for our mentoring clients, the first 3 months were really getting at the basics of developing a financial plan. We introduced you to Something More Mentoring. We did some goal setting with you. And then in month 2, we talked about your banking, your assets, those things that you own, your liabilities, those things that you owe, and you prepared a net worth statement, which will serve you very well throughout the rest of this course and hopefully for the rest of your life. In month 3, we got deep into your spending and you created a budget, a household budget, and we talked about your cash flows, where the money comes from, where it goes. And last month, we talked about the subject nobody likes to talk about, but it's really important, debt. And if it was appropriate, we developed a personal debt reduction plan for you. We discussed your mortgage if you have one. And we talked about credit issues, not only credit meaning debt, but how your credit report is developed and how to know the difference between good credit and bad credit. So as we enter month 5, that's your foundation. And we're going to get into a very specific topic, a very broad topic, but a very specific topic, insurances. So why do we buy insurance? I guess that's a question we all ask ourselves a lot. It's something that we purchase with the hope that we never need it. The graphic on the left really uses the words risk management. And to me, that's why we buy insurance. We want to transfer the risk. The primary function of insurance is to transfer all or part of a potential risk to another party. We're managing a risk that we have. And we have a lot of risks in life, and we're going to go through some of the more common ones today on this lesson. And if you have some individual risks, we'll certainly talk about them when we have your personal mentoring session. So the goal is to reduce that personal financial insecurity and make a loss, if you should suffer a loss, a lot more manageable. So think about your home. If you're a homeowner, if you had a serious fire at your home, would you be able to financially, and even if you were able to financially handle it, would you want to pay the cost of rebuilding? No, right? So we purchase home insurance, maybe because we have to, because we have a mortgage and they're telling us to, but it's also prudent to purchase home insurance to cover or to share that risk with the insurance company in case you had a catastrophic loss, right? So that's an easy one to think about, and most people really understand that. So we're going to really go broad here, and it's going to be fast moving. So we're not going to talk about every type of insurance. We're going to talk about some major types of insurance, but there are all types of insurance, you know, from life insurance to pet insurance and everything in between, that you probably are inundated in your life with emails and social media stuff and salesmen, mail, trying to sell you different types of insurance. And many of them are good decisions to buy. And some of them are more just sales based and things that you could really save some money and not buy. We're not going to cover every type of insurance, but just know there are many, many different types of insurance out there. And when we get to your personal mentoring session, we will talk about what you have, what you should have, and so forth. So, have you ever heard the statement, I just want the minimum coverage to get this car on the road? That's when you think minimum coverage, it's usually associated with a car. At least that's how I hear it. And it may be a teenager or it may even be an adult. You know, sometimes you buy something when you're not financially secure and you're stretching, you have payments, and you got to get this insurance just to get it on the road. And so you're thinking, how can I squeeze my budget a little bit? And I just want the minimum coverage. Well, that might be an easy decision the day you're buying the insurance. But what happens if you have a claim against you? Now, let's think about the car just for an example, because it's the easy one to think about. You get that minimum coverage, you get the lowest possible payment. So that means you don't have any collision coverage, you don't have any comprehensive coverage, meaning fire, theft, vandalism to your car. So if one of those things happen, you get in a car accident, maybe you total your car, maybe you just get a dent, maybe somebody steals your car, you break your windshield, you don't have any coverage, and that's relatively easy to understand. You're foregoing a premium and you're not having these types of coverage. So probably the worst case in that scenario is your car could be totaled and you're without a car. But there are other types of things that happen with car accidents. And you hate to talk about these things, but they do happen. You see them on the news. Maybe you don't think they can happen to you, but what if no fault, no intention on your part, but you miss a stop sign and you go through a stop sign and you get in a car accident and you injure someone. Or let's just say you're backing out of the shopping mall and you back into a Bentley. And if you don't know what a Bentley is, it's a lot of money when you back into it. And let's say you bought that minimum coverage, which was maybe $10,000 of property damage and maybe $20,000 of injury damage, liability damage. So do you know what happens if you have a claim against you and your insurance limits don't cover it? Let's use the worst example. You go through the stop sign, you hit someone else and they're injured, or perhaps even worse. The insurance company is going to write a check for the policy limit, in this case, $20,000, to whoever you were injured and at fault. And they're walking away. They're not defending you. They're not negotiating with you. They have met their obligation under the insurance contract, and you are on your own. So that day that you thought you were making a financial decision in your best interest of buying the minimum coverage has just had the most catastrophic result possible in this situation. And now you are going to be sued for whatever the amount is, the claim, hundreds of thousands, perhaps millions of dollars. You're going to have to hire your own lawyer. You're going to have to defend it. And if you have assets, maybe you have a house, maybe you have a business, maybe you have money in the bank. If you had a judgment against you, all those assets that you have could be subject to seizure by the court to pay for your liability in this case. Chris, this is just one of those things that is just so short-sighted for people to buy the minimum coverage that I can't emphasize it enough.
Yeah, it's so true, Jeff. It's great to be with you again for this this module. I was thinking as you were describing that, you could have a situation like that, the liability exposure, where you are on the hook for that person's inability to earn income. And I mean, it's not just about property damage. There's a liability that can last for many, many years and can create financial hardship if you're not adequately covered. Nobody likes the idea of being insurance poor. That is to say, have these enormous insurance premiums. But there's a reason we have insurance. It is a risk management tool, and it is an important tool in one's financial planning. It is a foundation that helps we can build on the creation of wealth. If we're not adequately covered when it comes to all kinds of issues, whether it's health related expenses, whether it's property and casualty like you're talking about, disability and life and all the rest, you can end up totally disrupting your financial plan, what you anticipate happening, what your intended long-term projected plan.
Right.
It can all be disrupted because of expenses that can be mitigated through the risk with the use of insurance. So the insurance is maybe not a fun, exciting topic, but it's a really fundamental part of one's planning. And there's, as you pointed out on the prior slide, there's so many different aspects of this to be paying attention to and things to think about. And to your point, we're constantly bombarded by the lizard or Flo or whoever it might be. We've got all these different kinds of possibilities. We don't know where to start. This is going to be a great resource to give you some foundation for thinking about what are the kinds of ways you need to plan and address these insurance needs that may exist. And everyone's are a little different different life circumstances can make that different, but we'll go over a variety of them that I think are going to make a difference.
We will, and I'll just say one other thing, Chris. Don't think that when you go from your coverage of, say, the minimum coverage to maybe a more reasonable coverage, depending on your financial situation, that your insurance goes up proportionally. As you're buying more and more insurance, especially on these homeowners and automobile and other liability coverages, your rate barely goes up. It does go up the more insurance you buy, but it's not proportional, meaning
Yeah, that's a good
doesn't
point.
triple and
Particularly when it comes to liability exposure, it is far less costly the more bulk you buy.
That's right. And so we'll definitely cover that in your personal mentoring session, and we can show you, discuss if you have adequate insurance, and perhaps encourage you to get some quotes for maybe additional insurance. Now we're gonna, for the people who have been with us the entire through all the lessons, I've said before, and it's a good time to say now, was we're not selling you any insurance here. This isn't the function of Asset Management Resources. We're a fiduciary, we're an investment advisor. I'm an investment advisor representative for AMR, and we're not selling you insurance. So don't think that any of this advice is going to result in a sales pitch somewhere at the end of the
Yeah, and I just, as a disclosure, I agree completely. I would just mention that some of our advisors do have insurance licensing. It is not their focus with our firm, but they can at times, as an outside business activity, be a resource if desired. But don't expect that that's the focus of our time and attention.
Very good, thank you. So and we've basically said this in the last slide, but insurance is a piece of your financial plan. When you're putting together a comprehensive financial plan, as we are through these lessons, this is an important piece. And in this respect, it's a process that will help you protect you, your family, your assets around all of these things that happen: death, serious illness, disability, as we mentioned, accidents, and other catastrophic events. So it's a piece of the pie here. It's a piece of the puzzle, as the graphic indicates. And it's an important piece. That's why we're dealing with it in a lesson all by itself this month. So let's walk through the 7 basic major insurances you may need. Now, this list is not intended to be exhaustive. Your personal situation, your profession, your risks, what you own, all are significant. Your family, your age, all these things will play into whether or not you have these types of insurance. But we're going to discuss these 7 throughout the rest of this lesson, and others we'll discuss personally during your mentoring session. So if you have a home, if you're a homeowner or a renter, you need some type of insurance. We talked about automobile. There's mandatory laws in most states. You have to buy it. So, and
and just on those first 2, Jeff, it's really about stuff, that you're thinking of. But
right.
Don't forget, both of those also have the liability aspect as well, that they're not just protecting your goods, your car, they're giving you that liability protection. So if there's some risk to you for, someone has a problem and they sue you because of your accident, or they slip on your step or whatever,
right,
there's liability protection. That's a really important part of this, to your point.
Yep. Liability is where the big money is for plaintiffs, for people suing you. And I wrote other vehicles because I want you to make sure that when you're thinking about insurance, that if you have a boat, if you have an RV, if you have a jet ski, we could go on the list for a while. But if you have another vehicle, even if it doesn't have wheels, think about the things that you do with that vehicle. Snowmobiles, it's endless.
Yeah.
And
nowadays people have these electric bikes and such, like
electric bikes, golf carts, where I'm
Scooters.
at, right?
Yeah.
So all these things are potential instruments of liability and injury, and so make sure that they're covered by individual policies, or maybe it's covered by an umbrella. And an umbrella, no, it's not for rainy days. Many of you have umbrellas perhaps, and many of you have never heard of the term. We're going to spend the a couple of slides on it, but for now, where we are in the lesson, just think of an umbrella as covering you beyond the other insurances that you already have in place. And we'll talk more about that in a few minutes. Health insurance is one that everyone should have. What types we'll talk about. Life insurance, most of you have heard about life insurance, but we'll go into why you have it and the different types. Disability insurance, meaning if your income is interrupted because of an injury, some of you, many of you may need that. Long-term care insurance, we'll talk about. It's basically care for you when you get older, although you don't have to be older, and who's going to pay for that, and can you pay for it yourself, or should you insure it? And we'll discuss your own personal needs along the way during your mentoring session. So let's start with number one, that homeowners or renters insurance. So before we talk about some specific tips on homeowners and renters, I want you to shop around. Whatever we're talking about, any insurance, shop around. We have this tendency to maybe shop around for things when we first buy it, meaning if we're buying a car, if we bought a house or we rented an apartment, we look around, we do a little research, maybe not as much as we should, but we do a little research, maybe get some quotes, and we get an insurance policy. And hopefully, most people, nothing happens, so we're not really thinking about it. You get a renewal notice, you just send in the check or send in the credit card number and renew it. I'm going to encourage you not only to shop around at the beginning when you first buy an insurance policy. I'm going to encourage you, maybe not every year, but every couple of years, to shop it around, see if you can get a better deal, see if you can save a few few dollars, and maybe review your coverage with your financial advisor and your insurance agent to see, what's happened in the last few years with the cost of homes. It's gone up dramatically. If you don't have an insurance agent who maybe is automatically increasing the value of your home, or you're reviewing it yourself and increasing it with the market, you may be underinsured. That's just one example of why you need to review coverages. And make sure that the company you're doing business with is strong financially. Insurance companies come and go. There's solid ones financially, and there are ones that are kind of on the edge. You can check, Chris, you can comment on this. You can check the strength of an insurance company by looking at different rating services, correct?
Yeah, there's multiples. The most familiar is AM Best, and but also these Comdex ratings and so forth. There's various resources that can be useful in this. You have to be careful of, is an A+ the highest rating, or is it an A++? AA sounds good. You want to make sure that you're clear what the scale is. There's different aspects of these kinds of considerations, whether it's claims paying ability as well as financial, resources that they have set aside and so forth. So there's lots of things to consider. I think I would just add one other thought on this page for your comment, Jeff, and that is the idea of going direct, to a direct provider, or going through an insurance agent.
That's a good topic,
there can be virtues to both, but I think for people who have the least familiarity with it, you may be benefited by going through an insurance agent who can kind of guide you and help you and shop around with you. And certainly at the time of claim, they can be more of a resource than when you're doing it on your own. On the other hand, if you have a certain, familiarity, you've done some homework, then maybe it does save you some money to deal directly with some of the different providers that are out there.
That is a good topic to discuss for a minute. Independent agents often represent more than one company. So by going to them, you're in essence shopping it around a little bit. And think about if you had a claim, how do you want to deal with that? Meaning, would you be more comfortable going into an office to talk to your agent and having them assist you walking through it? Or are you okay with calling an 800 number and working through any bureaucracy of one of those companies? As you said,
Right.
Chris, both have pros and cons, but there are differences. So think about what you're most comfortable with.
And sometimes it's worth a couple extra dollars even, and may not even require a couple extra dollars because of the expertise of what they bring. But, sometimes it may be worth having a little more cost to get the extra service.
Well said. Cover your assets and your potential losses, meaning you've done a net worth statement as part of this mentoring program, so you know what your net worth is. And so certainly the amount of coverage that you want to buy would be related to your net worth, meaning for those individuals who maybe have no assets, they're in the beginning of their working career and they're just starting out, the amount of insurance you would buy for liability protection, arguably, it still should be not the minimum, but arguably would be less than someone who's maybe 50, 60 years old. They've had a good professional career. They've amassed assets, perhaps in the millions of dollars. Someone in that position needs to think about if they had a potential loss, if they were sued for damages, they want to have more protection on their liability side to protect their assets from against a potential lawsuit.
I think this is a tough one, Jeff, too, because, someone's earning abilities could be impaired. That is, say, could have a lien or something if they have a big liability. So, it's not just what you have today, but what you may expect to have that you're also trying to protect. So, don't skimp on this.
Right.
And as you said, particularly when it comes to the liability, it does have a cost as you go higher, but the scale of that does go down. It is not proportional. So,
No.
it's a fine line, right? You don't want to overdo it, but it's not just your present self that you have to think about too.
I think I can't remember an example of someone I've counseled on liability protection, say going from $300,000 of liability protection to $1 million, just for an example. And the increase in premium, I can't think of an example that the person wasn't pleasantly surprised by the lack of increase for so much more coverage, right?
Right, exactly. And I mean, it is also one of these things, it's, what's peace of mind worth? You know what I mean? That provides a lot of peace of mind.
Yep. Remember, we're talking about insurance, that thing that we buy and hope to never need. And quite frankly, I don't know the statistics, but many of us will never have a claim against ourselves. But it is such a potential devastating impact on your financial life and your family that, as Chris said, don't skimp on it. Don't be cheap when it comes to buying a little bit of extra insurance.
Yeah.
So there are a lot of factors when you're talking about your homeowner's insurance. And, as the circle says to the left, just reminding you to shop around, not just for price, but for coverage. Just don't look at price, look what you're getting. Sometimes when you shop around, I know when we bought our most recent home, I get quotes for our new home. And I bought homeowners insurance probably more times than I can remember. And this time when we bought it, we got a really wide range of quotes. And I was looking at what was covered. And to my surprise, some of the coverages were just drastically different. One of the less expensive quotes we got, I was surprised. So I was really looking through the detail on the coverage, and it did not cover pets, which I was shocked. I thought every homeowner is, it might not cover. I was looking for dangerous dogs. We don't have a danger. Our dog is the opposite of dangerous.
Yeah.
But you do see that, none of the dangerous dogs, and
right.
where you have to pay extra, whatever. So I did not see pet coverage. So I actually called the agent who gave me the quote, and I said, I don't see pet coverage. And she said, oh, no, it's not in that policy. And if you have pets and have any experience with homeowners claims, a lot of the claims are dog bites, right? So, don't just go for coverage. Don't go for price alone.
Price only.
Make sure you're comparing the same coverages when you're getting the quotes. And lots of things affect your homeowner's insurance rates, as this graph from.
That's a great visual. It kind of covers it all.
Yeah. If you have a lot of claims, if you live in a bad neighborhood, your crime rate, the building material availability is certainly affecting homeowners rates right now. and your coverage options, how much you want, and the condition of your home. If you have a brand new home in a nice gated community and you've never filed a claim, no, you're going to get one rate. If you buy a house with a high crime rate, an older home with not in good repair, and you've been filing a claim every other year, you can't expect to get the same type of price. So just know there is a lot that goes into it. So make sure you shop around and shop.
And there
for
probably are
coverage
other
and price.
considerations too, but this gives you a good overview.
Yep. One of the other considerations, which isn't on this graphic, and it depends on the state and that you live in and the company, but credit worthiness is also one.
That was what I was
you-
thinking of too, Jeff. Yeah.
Right. So if you have, if your credit report is great, you might want to ask the agent that you're working with what companies are giving discounts for a good credit report. And if it isn't, you should work on that. Refer to last month's lesson. And know that it could cost you some extra money because your credit report is not favorable.
But may also be a factor in thinking about which company you utilize.
Exactly. Good point. So for this next segment, we're going to give you a broad overview of automobile insurance, and I decided to use this short video from Wallet Hub. So let's take a look at this.
When you've been in a car accident, you need someone to have your back. By purchasing car insurance, you can make sure that someone will. But there are many types of insurance that offer different kinds of protection. Which ones do you need? Let's walk through the 6 major types to find out. Liability is the one type of insurance everyone must carry. It protects other people when you're responsible for an accident. There are 2 sides to liability coverage: bodily injury coverage and property damage coverage. Bodily injury liability insurance pays medical bills, and it can also compensate people for things like lost income and pain and suffering. Property damage liability insurance pays to repair or replace other people's vehicles that you've damaged. It can also cover the cost of fixing fences and other kinds of property that you may run into. Collision insurance protects your own vehicle after an accident, even if you're the one at fault. You will be required to buy it if you use a loan or lease to obtain your vehicle. Otherwise, getting this protection for your own car is your choice. Comprehensive insurance protects your car against damage not caused by an accident, such as theft, falling objects, or natural disasters. It's usually purchased in combination with collision insurance, and, like collision insurance, you'll be required to get it if you have a loan or lease. What happens if you're harmed by a driver who doesn't have enough insurance to cover all of your losses? You're out of luck unless your policy includes uninsured or underinsured motorist coverage. Depending on where you live, you may be required to get this type of insurance. Even if it's optional, it's very affordable and provides important protection. Now let's talk about medical bills. If you're injured in an accident, they can stack up fast. But personal injury protection coverage, sometimes called no-fault insurance, can help with these costs. It makes sure medical bills get paid quickly, no matter who is at fault. And it helps with other expenses like lost income, childcare, or even a funeral. Personal injury protection is mandatory in 15 states, but even where it's not required, you may still be able to purchase it. In some states, there's a different form of insurance for medical expenses. Medical payments coverage, or MedPay, is similar to personal injury protection, but is more limited in scope. Unlike personal injury protection, it won't pay for lost income or most other non-medical expenses, but it does cover accident-related medical bills for you and your passengers, supplementing other insurance coverage by paying any deductibles and copays they may have. MedPay will cover funeral expenses as well. There are, of course, many other forms of insurance for car owners, such as coverage for roadside assistance or a rental car while your car is being repaired. But these 6 are the most important ones to consider. For more information on insurance options or to join the conversation on this topic, visit Wallet Hub's Types of Car Insurance page.
Now let's shift to this umbrella insurance. And as I said in the opening, think about it as an extra layer of insurance that provides protection beyond the existing limits and coverages of other policies. And usually we're talking, not, we can add other things, but usually it's a situation where you have your home covered, you have a homeowner's policy up to, and they require you to have certain limits. Your mortgage company will probably have you have certain limits. And if you want to get this umbrella insurance, you have to have minimum limits. And I don't mean minimum, I mean additional limits that the insurance company is happy with. And you have an automobile policy with adequate limits as well. So you have these two, and the common example is you have homeowners and auto insurance, and your liability protection, say, is $100,000 per person and $300,000 per accident. That's what I have found to be the minimum amount of coverage you need to have on those policies before you can buy an umbrella. Then you would purchase an umbrella policy, which provides additional coverage for things like injuries, property damage, lawsuits, and other liability situations. And let's say you purchased a liability, an umbrella policy for $1 million. That would be above and beyond the coverage you have for your homeowners and auto. So if you had a claim against, we'll use that accident that we started with, you went through the stop sign, it's your fault, you hit a car and you injured someone and did damage to their car. And Chris, as Chris said, maybe you have impaired the other person that you hit's ability to earn money, right? So you have a big claim here. Your auto insurance company is going to pay first. And then we're going to have something called an umbrella, which will go over that policy and then kick in for up to $1 million. So it's extra protection. And, you know, like some of these other protections we were talking about, to have $1 million of coverage over your other policies, unless you have some unique situation, is only going to cost you $300 or $400 a year extra.
Yeah, and we refer to it commonly as umbrella insurance. It's also called excess liability coverage. And as you said, so it sits on top of your homeowners, your auto, if you own a boat and have boat insurance, all of these kinds of other carried insurances. And it's whatever their limit of, liability exposure. And then it sits on top of that with another $1 million, $2 million, whatever amount you might want. And in the case you just mentioned, I mean, to buy an extra $1 million on top of your $1 million umbrella policy is a lot less than the cost of the first $1 million. So definitely worth examining. And, we're such a litigious society today. People sue people at the drop of a hat. And, having this kind of coverage really is, you might think of it as an extra, but it's really, I think, a necessity in today's world to have this kind of protection for the unforeseen.
And we've been talking, our example has been if you're at fault. But there are times when you're sued and the question of liability is not determined, right? You may think you're not at fault. The other driver, or whatever the case is, may think that you're at fault. If you have insurance, and adequate insurance, the insurance company will defend the claim on your behalf. And if you had the minimum insurance, I'm not saying they pay people to make them go away, but maybe it's not worth it to them to defend a claim that could be potentially millions of dollars if you only have $10,000 of coverage. So they may just pay, and then you're on your own, even ultimately, if you were found to be not responsible, think about the attorney's fees that you would have to spend to defend a civil case in court. So there's lots.
Yeah, just the attorney's costs are a big part of why, this kind of expense. So having now counts against your amount of insurance, but it helps you manage this claim kind of consideration. And if there's a judgment, that you're found to be at fault, you have a significant amount of help in dealing with that.
Yep. So we're going to be going through your limits and your coverages on your policies, and we'll make sure that you have coverage that you think protects your family. And we'll talk about an umbrella policy if it's appropriate for you during your personal mentoring session.
And if you have someone who is your insurance agent, certainly talk to them about this too.
Absolutely. health insurance. This is one of the biggest ones to talk about, but they're so different, all the policies out there, and it depends on your age. We're gonna
I
be a
have an
bit,
anecdote to share with you.
oh, please do, because this is a tough one to make sure we're,
So I was having a consultation with someone a couple years back. And, they had multiple properties and we were talking about their financial situation and, the wealth they'd accumulated and so forth. And in the conversation, there were other issues. They like hadn't paid taxes for years and all this other stuff. But one of the things that came out is they had no health insurance and no property and casualty insurance on any of their homes.
Mm.
And, on the one hand, they're saying, well, I'm saving all this money, but all of it is at risk with a potential claim on either of those. Kind of a health issue can be devastating financially, or in the case of their homeowners, a liability exposure, like we were just saying, could totally wipe them out, or they'd not be able to rebuild if there was a fire or whatever it might be. So penny wise, pound foolish. Health insurance is one of those areas. It's extraordinarily expensive. The cost of healthcare are very expensive and continue to escalate as a cost. And so it is understandably a strain and a challenge at times for people to evaluate how to deal with this issue. But, the risks of a financially devastating impact if you don't have coverage are so great that this is one of those areas that you have to have some coverage. And to your point, there are varying degrees of coverage and self, insurance, if you will, the portion out of pocket.
Mhm.
So, just keep in mind, the less coverage you obtain, the more risk you retain.
That's right.
So that's a challenge. And so in any case, have something, but I would expect this is something you really have to be willing to dedicate some of your resources toward.
You do, whether you're an individual person or a family, you really need to have some type of coverages, and we'll go over.
Even if you're younger and don't
Yes.
think, that it's not, oh, I'm healthy, you may not need as much, but it may not be as costly at that stage. And if there is the unforeseen, all the more serious and more consequential that you have some coverage to be available.
And if you don't have coverage, can certainly talk about options for you. If you're low income, there's certainly lots of programs from the government. Most people do get it from their employer. Some states still mandate it. There are, just to put some broad terms, there are some catastrophic policies in the market where you pay $5,000 or $10,000 up front, which really reduces your premium, but it's only going to cover those catastrophes, but it's still better than nothing. So we'll discuss with you some options depending on your age, whether or not you have a family, your assets. But to Chris's point, you have to have something. You can't just ignore this one. The risk of a potential claim is too great. And this graphic goes right into that most people cannot handle a catastrophic medical injury or illness. In fact, 62% of all personal bankruptcies include significant medical debt and unpaid expenses. Many cases,
it's one of the major causes of bankruptcy.
I was just going to say that.
Yeah.
Many claims in a bankruptcy court are solely related to a significant event. And you got to remember, you're not just discharging. When you go to the bankruptcy court and ask for forgiveness, is basically what it is. You're not just allowed to discharge or get rid of your debts and keep your assets. If you have assets, you have to use your assets, most of them. I mean, you can keep certain things, subject for another discussion, but you're not just going to be able to go in and declare bankruptcy because you have a medical event and keep all your other assets. They're going to work through you and basically see how much you can pay and take most of your assets to pay your debts.
I would just
Go ahead.
Sorry, yeah, I would just say, in broad stroke, there's really two major types of kind of coverage. One that you might have a deductible and some, cap on your out-of-pocket expenses type of an approach. And then another that's more of a gatekeeper HMO kind of thing, where there's a network of doctors that you can see. You have to go through your primary care physician. And by doing that, they try to keep costs lower. And, there may be some hybrids, a preferred provider option, and it may be some combination of the two. But there are all kinds of other variations to think in terms of, whether it's FSAs and HSAs and all these
Right.
different kinds of possibilities that would be better described in that personal discussion to help you strategize how to think about what are your best ways to deal with your planning around this area.
And because you said planning, Chris, I think it's worth a couple minutes just to discuss when we're talking to people who are getting ready to retire and getting ready to go into that next phase of their life, meaning retire and Social Security, pensions, withdrawing from their assets. The cost of health insurance, whether it be Medicare and a supplement, Medicare and a Advantage program, or if they're retiring before 65, is really a big piece of the discussion in their financial planning.
That's a great point. It becomes a cost we need to manage, particularly when someone is retiring earlier than Medicare eligibility. There are some good resources for people who are trying to evaluate, which plan is best for their medical, prescription considerations,
Right.
or, if they have certain healthcare needs. The organization SHINE is what it's called in Massachusetts. It's called something different in other geographies, but there's a group that is available to people to utilize for their expertise in finding what's the best plan for my particular set of circumstances.
It ends up to be those people that we're talking about entering or in retirement. It ends up to be one of the expenses that is often miscalculated, undercalculated for individuals who don't work with a financial advisor. If they're doing it on their own, they're not appreciating the amount of increases and the things that are not covered.
Yeah, it's a good point. The inflation costs of healthcare are usually on the high end of when we calculate inflation. So you want to track those costs at a higher inflation rate in your planning than you would other expenses, perhaps.
Right. So shifting over to not health insurance, but disability insurance, and for
Which
those
is a
folks,
type of health insurance technically,
right,
but
it is. It protects it protects your income if you're unable to work due to some health impairment. Now, there are many different types of disability insurance, and I've listed 6 below. There are more. Some of them you get through your employer automatically. If you're a member of a union, you might get them. Some of them are individual benefits that the employer pays. Some might be options that you can pay for. I think one of the most famous ones, although it's not an editorial or an endorsement, whether I like it or I don't, the quacking duck, Aflac, is probably the most known one because of their advertising, but there's all types, and then there's ones available through the government. But it may be prudent. This is really an individual conversation with your financial planner. We'll go over it as your mentor when we have our conversation, but it really depends on your your age, your occupation, other sources of income, and so forth. It's really, there's no, like, to me anyway, Chris, maybe you have a different view, but there's no broad kind of statement where we can say like everyone should have this and everyone should have this type of policy.
Well, that's a fair comment, because different kinds of work have different levels of risk. I think there is a risk to everyone, though, if that it is worthy of consideration of how do I manage this risk if I'm not able to work because of a health impairment. It may not happen on the work site. It may not be
Right.
workers' compensation.
Could be an injury at home, right?
It could be an injury. It could be an illness.
Sure.
We have clients who have found out that they have a prolonged debilitating impairment that limits their ability to work. And how do you deal with that? How would you be able to afford to make ends meet if you don't have some manner of help in the process? Now, for people who have a permanent disability, Social Security can be a resource and a tool that may help, but it may not be enough, candidly.
Right.
And it's very difficult to obtain because it has to be something that is. I have someone I'm talking to who has MS and still is trying to fight to get their Social Security disability, which is a progressive, debilitating issue. So and it's her doctor's advice, this kind of thing. So it's challenging, and circumstances differ from one person to the next. So take the time to think about it. That being said, it is more costly in many respects. The greater the likelihood of need, you have up here occupation. If I'm, if I'm swinging a hammer or I'm a welder or something, I'm going to have more risk if I'm lugging around beams and, bags or whatever it is of a back injury than if I'm sitting at a desk, right? And at the same time, if I have a very specialized skill set and I'm a brain surgeon, if I have a hand injury, that could really disrupt my professional capabilities. So, in the way we might structure that kind of risk, how to ensure that risk can be very different. And, I think it's something for people to just give thought to, try to examine. Earlier is generally better to obtain this coverage. Age is relevant to this. Health, obviously, you have to be healthy enough to qualify. And then, how much you make affects, you have to decide how much coverage you want to get. There's a cap to how much you can get because the insurance company doesn't want to over-insure you and take on more risk to motivate you to be disabled. And candidly, there's a lot of fraud in this line of insurance. So it does cause the rates to be a little bit higher. But you can envision instances where your family could really be in a hardship if you had a impairment that you weren't able to work, and what the financial ramifications would be.
Those are all good points. And this type of insurance, disability insurance, is a bit different when you think about it, meaning you're not intending to keep your disability insurance for the rest of your life, like a homeowner's insurance or a car insurance. You can end your disability insurance, in essence, when you have assets that would no longer require you to have income, right? You still may be working.
Financial freedom. If you've got the resources for financial freedom, then it's optional, isn't it? Yeah.
Right. To me, the people that need this the most, and I hate to put that narrow definition, but if you have a young family and you're working and you don't have a lot of assets, but you have a lot of people depending on your income, that would be the most vulnerable time for you. If you're still young, if you had an illness or an injury and you got people counting on your income and you have some assets, but not a lot, not enough to support you, this is where, in my view, you're in the most vulnerable state of having something tragic happen to you and you not being able to respond. But we'll talk about, go ahead.
Just two quick points. It's a really good point. One is, keep in mind, most people only can get like 60% of their income eligible to them. So imagine trying to live on 60% of your income. That's not going to be easy in and of itself, but at least it would be better than not. And then, depending on who's paying the bill, affects how it's taxed. So if it's your employer is providing the coverage, you don't pay anything. That's all subject to income tax when you get the benefit as well. If it's something that you're paying the premium for, it comes to you tax-free, and that can be a big benefit to reason why to maybe pay that so that if it became necessary. And as you pointed out, younger people have a longer time horizon and a greater probability that over their lifetime, their work lifetime, they're going to have a greater prospects of having a disability, even if it's not forever. You could have periods where you could have disruption in your ability to work.
Right. So it's very individualized, and we'll spend some time talking to you about it during our mentoring session. So life insurance, I love this graphic, because Chris, I know you've been in the business a long time, and I know you started a long time ago in the life insurance sector. But so many people, as simple as this is, so many people don't start.
Don't get
They,
it,
they
yeah.
start with, well, why do I need life insurance? I'm going to be dead, right?
Yeah,
So
it's only for people who care about someone.
that,
So
that's
if you
true.
don't care about people, you don't have to worry about it. But if you have people you love who are
Mm,
dependent on you financially, it is essential.
it is. Do you need it? Does everyone need it? No. I mean, if you're a single person and you have no one depending on you, if you were to pass away,
I mean,
arguably,
if you had big debts, perhaps you'd want
right.
those wiped out. But if as long as you have assets and a positive net worth, it's optional in that scenario.
But as life changes, you get married, or you find a significant partner, and especially when you have children, and then you start to accumulate things, the need for life insurance grows. And parents, or if you're supporting a disabled person, which might be, you might have a disabled child that might never be able to leave your home. So that's all these unique things that happen to us in life, and individual things really defines when you need life insurance and how much you need. And at the end of this slide, I maybe got a little sarcastic, but I'll just so you don't think of being too anti-life insurance agent, speak to your financial advisor first. You're building a financial plan. You have a financial advisor. They should be a fiduciary, meaning someone who works in your best interest. Get their advice about, do you need life insurance and how much you need? And certainly talk to then you can go into the market and talk to different agents, certainly.
Yeah,
But
I think that's a fair point. I mean, ultimately, this should fit into the context of your financial planning and what do you need? That being said, I mean, look, a life insurance agent, producer is a sales professional. They are a salesperson ultimately, in that role, and they're selling you a product. But that being said, they can do a good job of helping you to evaluate the pros and cons of which product makes the most sense for you. But I fully agree, you go through the process of the plan so that well, how much should I have really? What do I need?
I think
That's ultimately what you're trying to figure out.
you
And
are,
then
and
the
I
best
think
product to design around that.
you are, just to argue, so to speak, with you. Many insurance salespeople are not fiduciaries, correct? They are
Right.
not. They don't have a legal obligation, and there are many different types of insurance, life insurance policies, and their cost and their coverage amounts vary greatly. So
Yes.
I just don't want you to be at the whim of someone who's making
Yeah,
a commission
I would
on a.
concede that point. I will acknowledge though, for many people, this kind of an experience may be their first interaction with a financial professional of one type or another, someone dispensing financial counsel in the process of this. Now, they're motivated, they're not necessarily a disinterested party, to your point, and they
Mhm.
may not be a fiduciary. But for many people, this is their first experience dealing with someone to help guide them. What should I get?
Right.
And so it becomes, the point is, work with a fiduciary first, then work with the life insurance agent who can help you find the best product, the best fit, given the needs and inclinations you might have worked out with your financial planner.
Right. And I'll go back to something that we talked about in the very beginning. Shop around. There's
Definitely.
get different quotes for different types of policies. Do your homework, be an informed consumer, and make the decision that's right for you and your
I would
family.
argue there's a benefit to working with, if you're going to do work with an insurance agent, you want to work with a brokerage oriented producer, someone who can shop that around to multiple firms to say, what is the pricing that makes the most sense for the kind of product you want.
So let's dig into this a little bit more, Chris. I just jotted down a couple of, 4 common reasons to purchase life insurance. We talked about the need, but let's get specifically into the need. You have determined that you have a need, you have someone depends on you, or you have some other reason that you need life insurance. So it's usually that you want to replace the income if you should pass. I think that's the number one reason that
Yeah, you want a
people,
money-making machine. You plan on over your lifetime creating wealth and saving and investing and growing the wealth yourself. So what if you're not able to? What if you pass unexpectedly? You want to have suddenly the creation of a money-making machine. It's basically a lump sum of money that's going to be invested and generate cash flow. You can peel off income and use it for the surviving ones you care about, your family, your spouse and kids, whatever, maybe to draw income from to replace your money making ability. Now, you may end up using up that over time, but oftentimes people will use a formula that says, well, how much do I need? Oh, I'm spending $100,000 a year. I need to recreate that $100,000 a year. Well, we talk about the 4% rule oftentimes as a sustainable amount. That would mean I need $2.5 million of insurance as a ballpark.
right?
That's a quick rule of thumb kind of way to back into a number.
Sometimes people, when they're especially in the middle part of their life and they have maybe a mortgage and some other debt, they don't want to leave that behind. So they get insurance to eliminate that debt, to leave their spouse or their children with their assets without any debt attached to them. That's a common
Yeah, I
one
think
as
that's
well.
a very common approach too. And, it may sound like, oh, I don't know if I want to spend enough on 2.5 million. I'll just cover the mortgage. Well, there's also going to be burial expenses. Well, we do plan on sending the kids to college. How much will that be? You start accumulating like a list of things that you can say, well, these are the ways we'd envision and things I'd want to have money to address. And essentially a debt elimination or, some of these targeted objectives.
And then there are unique situations that may just be, a situation or a lifestyle or things that have happened to you. Chris, you added these next 2 bullets, in a liquid estate.
This
Maybe,
isn't everybody, but
right.
there are instances where someone has a lot of assets and they may even be subject to an estate tax. Let's say in Massachusetts, the estate tax is still $1 million. So if your estate exceeds that, there's some tax consideration, but I can't sell my real estate real quickly necessarily to cover that, or maybe I don't want to. Having a policy that would be there to generate needed liquidity, a family business. Oh, I want this child who works in the business to receive the business, but I don't want to be unfair to these other kids. I'm going to create insurance as a way to fill that void, and everybody's treated equally, as an example. Those are a couple of scenarios.
We've heard, you hear about in the national debate, not so much in Massachusetts, but the family farm that
Great
has to
point.
be sold upon the death of the owner, if you will, the parent, if you will, because of the estate taxes. And even though the
Yeah.
intent is to keep it in the family, they don't have the cash to pay the inheritance taxes.
It's a great point. It's also common, that last one, that a lot of times people have a second marriage and maybe there's an age disparity where, gee, my kids aren't that much different in age to my next spouse, right? So I want the spouse to be able to live in the house and to have the resources, but I don't want to not provide something to my heirs. Insurance can be a tool to accomplish some of those kind of objectives.
And the last bullet, Chris, I think you're talking about mostly here, people who are self-employed. And
yeah, smaller businesses, perhaps, maybe a couple of partners involved or something like that. You can look to insurance as a tool. It's beyond the scope of what we're going to really get into here today, but planning to extract your wealth from your business with a buy-sell arrangement. So there's insurance to fund that. Maybe it's a way to have some benefit to an employee that you want to keep. They get some insurance and some cash value accumulation over their career, sort of a golden handcuff kind of thing. Or there can be all kinds of different tools and techniques, but it's an area of expertise, and it actually it's a really good use of insurance as a tool. It's just one that we're maybe not going to get into in what we
Sure.
want to talk about here.
I guess the point of the slide is there's a lot of different reasons that people purchase health insurance, not just to replace their income. And
Right.
you touched on this a little bit, Chris, but I just outlined the two different ways to think about this. We talked about when you're determining how much life insurance do you need, or do you want to purchase. So I characterize it as the needs approach, which is when you kind of go through and make that specific list, right? You have a budget, you're listing expenses. I put in final expenses, childcare expenses if you have young children and are leaving a spouse behind or not, who's taking care of the children. Maybe you want to get rid of your debt. Maybe you want to set aside money for future college expenses, mortgage debt, and so on, where you're looking at each element individually and building a list that you're going to total out and say, if I should pass, these are the things that I want to be able to take care of with this life insurance, versus the income replacement, which you touched on, of coming up with a formula. You mentioned the 4% withdrawal rule, whatever it is, some type of formula that
Yeah,
works.
I think the 7 to 10 times that you mentioned here is a common calculation.
Mhm.
I think it may not fully capture what one's trying to accomplish, but it is commonly utilized. I agree. And so, I guess it's a question of whether you feel comfortable eroding that capital, or you want to create a sum that can be maintained indefinitely. I like the other approach, but sometimes people say, well, I don't want to spend that much on the insurance. So they're willing to erode the capital. I think it gives you a little room for cushion for inflation and for some of the unforeseen. You might plan for a certain level of income, but then when college comes along, you end up eroding some of the capital, and that might make sense. At that stage of things like that. So I think both of these are viable, and I think it comes down to how much you can afford as to how you want to approach it.
Right.
If you're really trying to pinch pennies, you're going to probably think more along the lines of the needs approach. If you have a little more flexibility, you'll probably try to opt for more of that income replacement. Ultimately, what we would really prefer is to do a financial plan and say, what's the number I need to recreate the wealth I want in case I don't get there?
Right.
And that's a moving target, by the way. As time passes, let's, recognize you might think in terms of I want to pay off my mortgage. Well, today you might have one mortgage, but 5 years, 10 years from now, you might be in a different house. The mortgage might be more costly. You might have, these are things that adjust and change. So it isn't something that's static. You do have to adjust it over time. And when you're younger, I would encourage you to sort of try to overestimate the number.
I agree.
Because if your health changes, you may not have the option to opt for more later. So that gives you some cushion for that kind of possibility.
Right. And the age and number of your children is such an important factor, as well as your debt. If you're debt free and you're older and the kids are out and grown, and it's a different equation. And in many cases, life insurance is not something that people keep later in life. Some people do for other reasons, estate planning and all the other things that we touched on and more.
I think that brings up, probably the next point, but the idea of like, what kind of insurance should you get? And the idea that there's different approaches to this that are both viable and reasonable. But generally, the kind of thought process I think most people tend to embrace these days is, I want to be able to create the wealth myself. I'm not looking for my insurance product to be my wealth creation tool.
Right.
So most people want it as a safety measure while they go about creating the wealth themselves. And so it's intended to be temporary in nature. And if it's temporary in nature, that really lends itself most likely to term insurance as the structure, the product type most people want to use. You've got a few of them listed here, and the decreasing term is really mostly a thing of the past. It was historically tied to a mortgage, and you'd pay the same premium, but the death benefit would decrease presumably as your mortgage went down. Most people don't do that today because they tend to move and change, things change, right?
Right.
So that's less common. An increasing term is basically, for most instances, an annually increasing premium where it's cheap for a few years and then it starts to get more costly over time. So if you anticipated having a need that was very temporary, 3 to 5 years, that'd be a good type of structure for that kind of a use. Most people think in terms of the A on this graphic, level term. So it's a level premium and a level death benefit for a period of time. It could be 10 years, could be 15, 20. There's even a 30-year level term sometimes. Most common are the 10, 15, and 20. And you have to be healthy and show to be qualified. But ultimately, whatever that premium is in your rating, it's constant throughout that life of that policy. And there may even within that time frame be options to convert it from a term insurance policy to a permanent product if, say, for example, your health changed and you weren't able to qualify to renew. 20 years is a good ballpark, but you could envision at the outset saying, oh, I'm going to get 20-year term, thinking, well, I may pay off my mortgage in that time. I have a child. Okay, they'll be in college by that time. But then it turns out maybe you've moved, maybe you had more than one kid. You probably aren't going to be done with just one policy in that timeline thinking. But ultimately, when you get to the back end of 25, 30 years out, the ideal is that you've created the wealth and you don't need the insurance anymore.
Right.
There are instances, sorry, go ahead.
I was going to say term insurance is the least expensive option, right?
It's the least expensive out of pocket annually, in that it does not accumulate any cash value. So people would argue that a permanent product would potentially be less cost in total because you would eventually have some cash value associated with it, where you might exceed what you paid in. But in real practical terms, yes, in term insurance is a lot less costly. And what's most important for most people is having the right amount of death benefit. This death insurance is really what we're talking about. We want to make sure that if we die, their money's there. So for most people, that's much more important than having a vehicle that could also provide some supplemental cash reward. But that being said, there are times when it does make sense, either as a base for one's insurance needs, maybe they want to have something indefinitely, and there could be other circumstances where, for example, we may want a policy to always exist. Sometimes, for example, people use insurance as a pension maximization. They may take a single life option, but they want insurance to be there to recreate the pension if they die too soon, but they may want that forever. And that could ultimately go to, a reason why we might want it forever, right? As opposed
that
to
ends up just to be a math problem, right?
Right, exactly. Now, there's different types of products and different kind of circumstances. The most commonly talked about is whole life. It's traditional whole life. This basically is a policy that has guaranteed premiums, guaranteed cash values, and it has the expectation of dividends that can be received each year, and they may grow over time, typically applied in what's called a paid up addition, a little bit of additional life insurance, a little bit of cash value. And so the policy might grow over time. Eventually, one might be able to stop paying premium on it because of those accumulated cash values, and the dividend may be of a size that it can cover the premium 20, 30 years out kind of thing. Most common, though, is that people pay it indefinitely. Okay. When it comes to universal life, it's also sometimes called flexible adjustable life. This is basically, think of a bucket with money going in each premium payment, and it's intended to increase in value with an interest rate over time. And every month a mortality expense comes out. Now, that mortality expense when I'm younger is cheaper, and as I age gets higher. But if I'm able to grow the cash value in the bucket, I don't need as much death benefit cost because some of it's in my bucket, if you will.
Right.
And so This can be very flexible. Businesses like this, when they have unpredictable cash flows, where they might have an insurance need, but they can alter the premium from one year to the next once there's some cash value in there. They can have a little more flexibility about it. Households can do this too. You have to be very careful because it can ultimately use up the cash value,
Right.
and the policy can die off and go
Just
away
when you
without
need it, right?
yeah,
Yep.
not when you're expecting it to. There's
Yep.
other variations on this with variable life and indexed life. These are essentially just different investment mechanisms in the bucket, but similar in concept. I would just point out that a lot of insurance policies, when they're permanent insurance policies, have a lot of cost associated with the design behind them. So you really have to understand how they work. Generally, a product that's sold by prospectus will detail all of the various costs, whereas products that are not sold by prospectus do not. So it's a little less transparent. So, you know, you do have to shop around, again, to your point earlier, Jeff.
It is complicated, especially someone buying their first policy, to know the right type of policy. So that's why, I guess maybe going back to my sarcastic comment a few slides ago, work with your financial advisor first. Talk about your life insurance needs, how they fit in the comprehensive financial plan, and then do your shopping as an informed consumer. So we're going to shift now to another least favorite subject of everyone, long-term care insurance. And I think, I don't know, younger people may not have heard about long-term care insurance, or certainly thought about it. Maybe people in retirement are focusing on it, but it's something everyone should be educated about, whether you're ready to consider this or not. But long-term care insurance helps you to pay the cost that are typically associated with long-term care. Now, that the definitions will vary. Most people think about this, but it's not limited to residential nursing home cost. But as the second bullet indicates, it's important to know that other medical services, such as services provided in the home, may also be covered, or often are covered.
It may
right?
not even be medical. It can be chore services, you know, home health care, assisted living. You know, we tend to think of it as nursing home, but
Right.
it can be a range of things. I tend to think of you know, this is disability after we're done with disability insurance. You know, disability is in your working years. We tend to think of long-term care as a similar kind of you know, circumstance, someone's morbidity, not their life expectancy, but how healthy they are while they're alive. You know, you tend to think of it most often needed as people near retirement. People tend to buy this in their 50s and 60s and 70s, primarily 50s and 60s. And there can be various types, by the way, as well. There's the traditional type of policy that we're talking about, but there's all kinds of hybrid possibilities too. So we don't want to overcomplicate it, but it is underwritten. You have to be healthy to qualify.
And that's one of the reasons why the advice is usually to consider it. You know, don't wait till you're 80 years old and like think I might need this, because you may have developed a medical condition and you can't buy it if you wanted to, but to start to consider whether or not you should purchase it as you're approaching 60. Is that fair, Chris?
Yeah, I think I think of this as a wealth preservation tool. You know, I think of, you know, people tend to look at it in their 50s and 60s, as I said, but I favor more in your 60s, because as prior to that, you're in a wealth creation mode. Mm-hmm. And I'm more inclined to want to put my energies toward creating the wealth. And this is a tool intended to help protect that wealth.
I know it's certainly a substantial part of the conversation when we're talking to clients or would-be clients who are planning their retirement, but whether
it's a substantial risk, isn't it? Right? You know, that we often stress test people's plan with, what if you have a prolonged long-term care event? What if both of you do? You know, how will your resources stand up to those kinds of challenges, and it varies greatly from, not only because of the wealth people have, but what kind of fixed income resources they have. Do they have a pension, or are they fully dependent on their portfolio? All of these can really create differing some consequences. Obviously the amount of wealth once created can have an impact. But here again, just like the home, someone could have a substantial amount of wealth and say, well, I'm just going to self-insure. You wouldn't really do that on your house, because not only if you had a fire or the liability, but because the damage could be too significant. It's not, there's a cost benefit. The cost of insuring is more manageable than the cost of out of pocket of having to pay the whole thing. So not for everybody, I grant you, and it's certainly, it's an expense that, if you have limited resources, you really have to be deliberate about, is it enough benefit, or does it drain my resources?
Right. Does it diminish your quality of life as well?
Yeah. So you really have to be thoughtful, and getting counsel is helpful in this process. This can pay out in a couple of different ways. There's really two primary times when this is useful: when one has a cognitive decline or an inability to perform certain activities of daily living. And we can come back to that if it's appropriate.
We have that on a future slide. So this, from the American Association for Long-Term Care Insurance, this graph is just indicating on what percentage of people in different age categories are likely to suffer a need when the claims begin. Obviously, you see that peak from 80 to 84, and half the people are using it between 80 and 90. That's something that we would expect. But you do see that people less than 70 years old, 8% of those individuals, and ultimately 19% of people 75 and below do have a claim. So it's not just for the people 90 and above. It does span the entire senior age.
Yeah, I think they say that something like 1 in 5 or 1 in 4 of people who are 85 or so and over live in a nursing home. So the prospects increase as you age, the probabilities of use. But keep in mind, this isn't just for nursing home. This can be at home as well. And most people would prefer to receive their care at home. And this can be a useful way to help permit that, because you have the resources to make it available. I would just point out that this is not necessarily medical insurance. You still have, Medicare or a supplement to pay for what is acute doctors and medical visits. This is intended for care that is not covered by those things, typically, or at least for a prolonged time. And it is intended really for the kinds of, what we might think of as these inabilities, bathing, toileting, transferring, eating, dressing. If you're not able to do 2 of those, you're likely to be eligible for assistance with the policy or a cognitive impairment.
That's right. Chris, I loved your kind of note of, this is disability insurance like for people who are older, right? So, you're living in your home, you want to live in your home, you want to stay in your home. And if something happens, as the second bullet indicates, 2 of those 5 things lasting for 6 months of longer, or likely to last, I should say, expected to last. These are things that would inhibit you from being able to stay in your home. And if you have a long-term care insurance policy, this would help you pay for that. It is not like, and I guess we should note, maybe I should have had a whole slide on it. This isn't like they pay for whatever the cost of the coverage is. You're buying either a daily benefit for a period of time and a maximum benefit. So
yeah, it's a great point. There's some choices you have to make as to how much coverage you're going to obtain. I would that's a great point, Jeff, to maybe point out there's really 4 primary characteristics when you're looking at a traditional long-term care policy. The daily or monthly benefit is the first decision. there's essentially like a deductible, an elimination period. How much before how long before the policy kicks in? Usually people do 90 days, 100 days, whatever the product structure would be. The reason they do that oftentimes is because they expect Medicare might help
Right.
some in that period. That's not always the case, but that's the reasoning. There's a hope that they might get some help in that process. The duration of the benefit, 2 years, 5 years, whatever it might be. And essentially what that means is that if I take the maximum daily benefit, what's the minimum length of time it would last? Oh, it's 3 years. Okay, but if I take less per day because I'm in home care, not nursing home, oh, it might last longer,
Right.
as an example. And then, do you want to hedge inflation? How much? How do you want to structure? There's usually an option for an inflation consideration.
Which increases, all these things increases your premium. So
Exactly.
they're all decisions. Yep.
Exactly. They all are affecting the premium. And if you don't adjust for inflation, you can envision if you're, 60 years old and thinking I might need this when I'm 85. Well, it's probably going to cost a lot different. So you really need to have some inflation feature. And people who say, well, I'll just buy more along the way, usually get priced out because, to buy it at 60, it's one price, but 63, 66, 71, whatever it is, you get these 69 and so forth, 72. You get these different price points, and at some point you go, this is just too costly.
Right.
I can't, and you get priced out of it, so you don't end up buying it.
We started our session by defining insurance and talking about transferring risks, and long-term care insurance does just that. It transfers a part of the risk that you could have. It does have limitations. The premiums aren't stagnant, meaning if you buy a premium when you're 60, you can't expect it's going to be the same premium. There's a lot of moving parts in it, but depending on where you are for your net worth, your age, your health, your family, this is a tool that is something to consider.
I agree. And to your point down here, the probabilities that someone's going to have some need of either nursing home care, or that doesn't account for the home care, there's a high probability. There's different policy types, as we said. And, I think that there is a validity to the point you just made, Jeff, that insurance companies have raised premiums, and that may be a risk. If you think about, though, how this product has evolved over the last 20, 30 years, it's materially different. It was a fringe product in the 80s. In the 90s, the HIPAA legislation created some standardization. It's become a mainstream part of one's retirement, financial, and estate planning considerations. And so the persistency, people keep the policy now when they used to drop it after just a couple of years. Of course, interest rates have been very different in that period of time than prior to it. And so the claims have gone up, people living longer and using it. So that could continue, but it seems like the insurance companies have raised the prices considerably to address that. And of course, interest rates, hopefully they start, they are higher over the next 20 years than they've been over the last 20 years. Certainly. So that may affect this consideration.
And we've talked about cost a little bit, but this graph is just designed to demonstrate that the average stay in a nursing home is about 835 days, according to the National Care Planning Council. And the cost for that for a year would be $108,000. I noted here, as you indicated in our previous discussion, that some states, such as Massachusetts, that cost is significantly higher.
Yeah, I think it's in the ballpark of $160,000 a year in Barnstable, where I am. That area. So anyway, it's going to differ. Where you plan to retire, where you may have family. Those all may be various considerations that would be worth thinking about as you entertain how much to insure this risk.
How much coverage to buy, right? If you're buying, $100 a day versus $300 a day, how much are you mitigating? How much can you cover yourself from your other pensions or assets? It's
Exactly right. And there are other variations, are there state rules or state, considerations that could factor into your thinking? So there's lots of variables. Again, it comes back to the idea that everyone's situation is different and it's best dealt with in the context of a financial plan. Ultimately, if you can avoid the insurance, everyone would prefer to, but you want to make sure you have a significant cushion. And if you don't have that ability, you may prefer to have some mitigation of risk. Unless you're in a position where you worry about running out of resources anyway, and this would
right.
probably not be a good tool in that
And
scenario.
public benefits would probably be your best option. So
Yeah.
yep, a lot to think about here. If you're if you're below 30, I hope you at least learned something. You don't have to think about this right now, but you've learned a little bit. And
Well,
if
you may
you're
have family members that you're going to deal with
that's an
too.
excellent, yeah, your parents or grandparents. That's good. That's like very true, Chris. And if you're, as you start to think about your retirement, make sure you're talking to your financial advisor and include this in your plan. I'm not saying to include or not include the insurance, but include the subject
as part of your consideration.
That's right.
Yeah.
So as every session, for those of you who are involved with the personal mentoring sessions, you have homework. And for this month, I want you to review all of your insurance policies. This is going to take a little bit of time, I know, but it will pay off, make you more prepared, make you more knowledgeable about what you have. What is it adequate? Could use some tweaking. Do you have a gap? So get your insurance policies out for each of these areas or other areas that may be unique to you. Look at the types of coverage, the coverage amounts, and the date of renewal. And when we meet for the one-on-one mentoring session, we're going to go through each one with the goal of making sure you know what you have and the coverage you have is adequate for your situation and to protect you and your family. So in the event of one of those things that happen, and we see them on the news and they do happen to us sometimes, that you won't be surprised and you'll be covered. Thank you so much for your attention. I hope you learned something.
Jeff, I think you covered the content that could have been done in multiple lessons. You covered a lot of ground, and I know it was a little bit longer than your usual. I hope I didn't throw too many comments in, but you covered a lot of ground with this lesson. That's a lot to cover.
I really appreciate you being with me on this one, Chris, as always, but especially this one. I know you started your career in the financial services sector on the insurance side, so I appreciate your insight.
I think it's really important and it's challenging, and there's a lot to learn, and get help is, I think, the bottom line to my message. Whether it's about your homeowners and property and casualty needs, or whether it's about your life insurance or all of it, you're better to do this with counsel and guidance rather than try to do it alone.
Absolutely. Thanks for sticking with us, and until next month, take care.